Big tax changes for property investors, Federal Budget 2026 explained. Today, we are covering some major tax announcements from the Federal Budget 2026 that could significantly impact property investors, family trusts, capital gains tax outcomes, negative gearing strategies, and future property purchases. But before we start, there is one very important thing you need to understand. These are currently budget announcements only. They are not tax law yet. For these changes to become law, the government must introduce legislation. The legislation must pass through parliament, and the final rules may still change. So at this stage, do not panic, do not rush to sell properties, and do not make major decisions purely based on headlines. Now, let's break down the key proposed changes. First, negative gearing changes. Currently in Australia, if your investment property makes a tax loss, you can generally offset that loss against your salary or other income. For example, if your salary is $150,000 and your rental loss is $20,000, you may currently only pay tax on $130,000. Under the proposed changes, from the 1st of July 2027, negative gearing would largely be restricted to new builds only. This means that if you buy an established property after budget night, you may no longer be able to offset rental losses against your wages. Instead, those losses may only be used against future property income or future capital gains. However, if you already own property before budget night, the current rules are expected to continue. This is commonly referred to as grandfathering. New bills are expected to remain eligible for full negative gearing benefits and existing deduction rules. This proposal is clearly designed to encourage investment into new housing supply. Now let's talk about capital gains tax, or CGT. This is potentially one of the biggest proposed tax reforms in decades. Currently, if you hold an asset for more than 12 months, individuals and trusts generally receive a 50% CGT discount. For example, if you make a $200,000 capital gain, only $100,000 may become taxable. Under the proposed budget reforms, from the 1st of July 2027, the government proposes replacing the 50% CGT discount with an inflation indexed model. This means investors may only receive relief for inflationary growth rather than a flat 50% discount. The government has also proposed a minimum 30% tax rate on capital gains in certain situations. Importantly, the main residence exemption is not expected to change. Existing gains before the proposed start date are also expected to receive transitional protection. New bills may still retain access to the 50% discount option if implemented. These changes could significantly impact long term investors, high growth suburbs, property flipping strategies, trust structures, and retirement planning. Next, let's discuss discretionary trust changes. From the 1st of July 2028, the government plans to introduce a minimum 30% tax on discretionary trusts. This could impact family trusts, income distribution strategies, asset protection structures, and small business groups. Some exemptions are proposed, including fixed trusts, super funds, certain farming income, and some deceased estates. The government has also proposed 3 years of rollover relief to assist with restructuring. But again, these are proposed changes only. The final details are not law yet. So, what could this mean for property investors? We may see investors shift toward new builds, dual occupancy developments, and build to rent projects. Existing properties may become less tax effective and more cash flow sensitive. Trust reviews may become increasingly important, especially for high income families, multi property investors, and business owners. Tax planning may also become more important than ever before. Future decisions may depend heavily on purchase date, ownership structure, asset type, timing of sale, and debt strategy. Now, I want to repeat something very important. These are budget announcements only. They are proposed reforms. They are not enacted tax law yet. A lot can still change. We will continue monitoring draft legislation, Senate negotiations, commencement rules, transitional provisions, exemptions, and carve outs. Final thoughts. If these changes proceed, Australia's property tax landscape could change dramatically over the next few years. But good investors adapt. In many cases, structured timing, cash flow, and long term strategy will become even more important. If you are buying property, selling property, using trusts, building a portfolio, concerned about CGT, or reviewing your tax strategy, Now is probably the right time to seek advice before making major decisions. If you found this video useful, please like the video, subscribe to the channel, and share this with another property investor. And comment below, do you think these proposed changes will help first home buyers or hurt property investment in Australia? Thanks, everyone.